Welcome to your Fast Start Guide to Banking and Retirement at 19. Today we cut through jargon and misinformation, and we build a rock-solid sequence that takes you from your first paycheck to long-term wealth. We will move step by step, from setting up the right bank accounts to using retirement accounts the right way. Let's begin. First, I will set expectations for what you'll learn. We are going to start with banking basics, move into the correct order of financial priorities, then compare bank options, and finally transition into retirement accounts with a clear action plan. Before we dive in, a brief disclaimer. This video is for education, not financial, tax, or legal advice. Your situation is unique. Verify current IRS rules, contribution limits, and income thresholds. Confirm FDIC or NCUA insurance with your bank and read fee disclosures. When in doubt, consult a qualified professional. Here is our roadmap. We begin with a mythbuster, then the banking sequence, followed by choosing a bank. Next, we cover building your emergency fund in a high-yield savings account. After that, we discuss the order of retirement contributions. 401k match first, then Roth IRA. Then we finish with an action plan and quizzes to test your understanding. Let's lay down the exact order. First, your paycheck must go into a checking account. You cannot deposit your paycheck directly into a Roth IRA. A Roth IRA is a retirement investment vehicle, not a day-to-day bank account. Next, you set up a high-yield savings account to build 3 to 6 months of living expenses as an emergency fund. After that, if your employer offers a 401k match, contribute enough to get the full match because that is effectively free money. Next, begin consistent contributions to a Roth IRA. Finally, once these foundations are secure, increase aggressive investings. This sequence protects you from surprises while still letting you capitalize on compounding early. Here is how to choose your bank. Physical banks or credit unions are useful if you handle cash frequently and value in-person service and local ATMs. However, be careful about monthly fees and minimum balance requirements. Online banks typically offer higher interest rates on savings accounts and low or no fees, plus strong mobile apps for automation, but cash deposits are less convenient. The best choice is the one that fits your habits while minimizing fees and maximizing convenience. This mind map organizes the trade-offs. Under physical banks and credit unions, we highlight strengths like cash handling and local service, along with potential downsides like monthly fees. Under online banks, we emphasize higher HYSA rates and no-fee structures, while noting that cash deposits are more difficult. The final branch, What Matters, distills universal criteria: zero fees, FDIC or NCUA insurance, automation features, and responsive support. Your emergency fund target is 3 to 6 months of essential expenses. Calculate it by multiplying your monthly costs by 3 to 6. For example, if your monthly expenses are $1,200, your target range is $3,600 to $7,200. Keep this money in a high-yield savings account where it is liquid, separate from your checking, and insured. Do not invest this money in volatile assets because it must be available on short notice. Set an automatic transfer each payday to reach the goal predictably. This table summarizes each account. Checking handles deposits and bill payments and should have no fees and a solid app. The high-yield savings account is for your emergency fund and short-term goals. Prioritize a high interest rate and insurance. The 401k is employer-sponsored. The key benefit is the match and access to low-cost index funds. The Roth IRA offers tax-advantaged growth. Choose a reputable broker with automation and low fees. Access frequency varies. Use checking daily, savings occasionally, and contribute to retirement accounts regularly. Now let's translate this into a one-afternoon setup. First, open a no-fee checking account. Next, open a high-yield savings account and link it to your checking. Then turn on automatic transfers from checking to your savings each payday. Enroll in your employer's 401k and contribute enough to capture the full match. Open a Roth IRA and set up a recurring monthly contribution. Finally, revisit your contributions periodically and increase them as your income rises. Quiz time. The question is, true or false, you can direct deposit your paycheck straight into a Roth IRA? The options are true, false, only if you are under 21, or only if the Roth IRA is at your bank. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is false. You cannot deposit your paycheck directly into a Roth IRA. Your income must first go into a checking account, and from there you can transfer funds to your brokerage to contribute to your Roth IRA. A Roth IRA is funded with after-tax dollars, and qualified withdrawals in retirement can be tax-free. Starting at 19 gives you the longest runway for compounding. Always verify current IRS rules for eligibility, contribution limits, and income thresholds. The earlier you begin consistent, diversified investing, the more compounding works in your favor. This timeline shows how early actions compound over decades. At 19, you open checking and savings and begin small Roth contributions. In your early 20s, you complete the emergency fund and increase Roth contributions. By 25, you capture the full employer match. By 30, you automate contributions toward the annual Roth maximum, subject to current IRS limits. In mid-career, you raise contributions as income grows. Later, you may qualify for catch-up contributions depending on current rules. By retirement age, you have benefited from decades of compounding. Second quiz. After your emergency fund is set, what should you fund first? The options are Roth IRA, 401k up to the employer match, more money in checking, or a speculative crypto coin. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the 401k up to the employer match. The match is essentially free compensation. After capturing the match, contribute to a Roth IRA consistently. This ordering maximizes employer benefits while still taking advantage of tax-advantaged growth. Let's recap the pillars. Your paycheck goes into checking, never directly into a Roth IRA. Build 3 to 6 months of expenses in a high-yield savings account before aggressive investing. Capture your employer 401k match first. Then contribute consistently to a Roth IRA. Avoid fees wherever possible, and automate your system to stay consistent. To wrap up, here is your 5-minute action plan. Open a no-fee checking account and a high-yield savings account. Automate transfers to build a 3 to 6 month emergency fund. Enroll in your 401k and contribute enough to receive the full employer match. Open a Roth IRA and set a recurring monthly contribution. Revisit and raise contributions as your income increases. Thanks for watching. If you found this valuable, please like the video, share it with someone who is just getting started, and subscribe for more practical finance content. I would love to hear your questions, experiences, and hot takes in the comments.